Welcome to the OMZ Property Podcast, your go-to guide for navigating the world of property investing. I'm your host, and in every episode, I sit down with property investors, developers, and top industry experts to share their insights, strategies, and inspiring stories. Whether you're a seasoned investor or just getting started, join us as we explore all aspects of building wealth through property. Welcome back to another episode of the OMZ Property Podcast. Today, I'm joined with Jake from Innova Property. Jake, how you doing?
Yeah, very good, thanks. Thanks for inviting me on.
No, you're very welcome. Thanks for coming in. I've been following you guys on Instagram for quite a while, and thanks for making the journey.
Yeah.
So I believe you've come from Bristol.
From Bristol, yeah. So we're Bristol based. So not too bad on the train today.
Excellent. I know a little bit about Bristol because I went to university there.
Ah, great.
So I spent a couple of 3 years of my life in Bristol, as you do, student halls and then accommodation for a couple of years. So I've sort of got familiar with the area. And actually, funnily enough, I'm going to let you introduce yourself in a minute, but just before we do that, funnily enough, it was the first time I ever realised what a HMO was when I moved out of student halls into a shared house with my other student peers.
Same, yep.
And then thought, bloody hell, this landlord's making an absolute fortune here, because we're all paying, I think at the time, I may be wrong, about £450 a month it was.
Sounds about right, yeah.
And there was 5 of us in the house. So I was thinking, surely he's making an absolute fortune. So that was the first time I ever, but we'll come back to Bristol. Would you mind just, for the purpose of the people listening and watching, could you just introduce yourself, tell us a little bit about who you are and what you do?
Yeah, of course. So my name's Jake. I'm one half of Innova Property. So I run this portfolio with my partner, Lucy. So we are Bristol-based property developers, investors, kind of bridge the two, really. And we've got quite a varied sort of portfolio. So we've got a group of companies. We've got our investment business. We've got a development and sort of trading business where we flip stuff and sell it on. And then we've got a separate sort of service-based business, which is all around sort of consultancy, mentoring, a bit of project management. Mm-hmm. So they're the kind of the group of companies. Within the kind of property strategies, we kind of do a bit of everything. HMOs are kind of bread and butter. So that's what we focus the majority of our time on. So the investment portfolio, a good chunk of that's HMOs, but we also do small commercial-to-resi conversions. We do freehold blocks of flats. Mm-hmm. We do a lot of flipping. So whether that's individual houses, again, buying multi-unit freehold blocks, chopping them up and selling them off individually, or whatever kind of makes money, really.
Yeah,
so, that's kind of us in a nutshell.
Amazing. So I believe that you guys won an award at the Property Investors Award. Was that the last?
Yeah, so November 24 last year. So we won the HMO Investor of the Year.
Amazing. Congratulations.
Yeah, thank you very much.
Yeah. And I believe from talking to other people that have won these awards, the application form is no small task.
No.
Could you talk me through the level of detail that you have to give to actually enter to one of these awards? And has it done anything for you in terms of credibility and the actual process of going through and demonstrating? Because one of the things I find in property is there's no real, it's not like other industries, and you can sort of excel and then win achievements and awards and things. And that's kind of, it's certainly in financial services, that's people absolutely love bragging about all the awards that they've won. Yeah. In property, the awards have only really been around, I don't know, maybe 5-6 years. I might be wrong there. And there's a few of them, but they do seem to be worth entering if you are doing good stuff. So what do you think about it?
I think you're right. And the Property Investor Awards in particular was, they really scrutinised you and your deals and your business. Mm-hmm. So you had to upload a lot of evidence. So obviously you've got your application, which talks about you and your business and the specific deals that you've done within that time frame. Mm-hmm. So ours wasn't for a specific deal; it was for our approach in general, and obviously what we'd achieved within a 12-month period. Mm-hmm. And we had to upload things like completion statements. We had to upload mortgage offers. Everything that kind of can prove that the figures that you're talking about are accurate. Mm. And that gets scrutinised by, I think it was something like 30 people.
Yeah.
And then everybody votes. And then the winner is obviously the one who gets the most votes. Yeah. So it does feel like it's really heavily scrutinised. So I'll be honest, we had no expectation of winning that award.
Yeah.
We thought, it'd be great to be shortlisted.
Yeah.
And there were some big, other investors in that category. But we won. So super grateful.
It's one of the most popular categories, actually, the one that you've gone in for. So it's not like because some of them are quite niche, and I think that they have less applications, but yours probably had. I think a couple of years ago, I looked at the application form and I was just like, this is going to take me about 3 weeks to complete this properly. So I just moved on. But it was, well done. Really, really good stuff. So you can share that everywhere now, can't
Absolutely,
you?
Absolutely, It's on the email signature.
Fantastic. Amazing.
Sorry to interrupt, but I just wanted to introduce a sponsor of the channel. Trinity Finance is a directly authorised FCA regulated mortgage brokerage. Founded in 2015 with over 30 mortgage brokers, we're really well placed to help you with all your property finance needs. Starting with first-time buyers and those moving home, we also help people remortgaging residential and buy-to-let property. Alongside that, we specialise in ground-up development, commercial lending, HMO funding, mezzanine, auction, and also your traditional buy-to-let. If that's of interest, get in contact with us via email at info@trinityfinance.co.uk, or you can give us a ring on 01322 907 000, and we look forward to hearing from you.
So let's talk a little bit about, if you don't mind, the Bristol market and what you're doing day to day. And I'm super keen to learn more about HMOs in particular in that area, because one, I've lived there for a while. Two, I invest in HMOs in other areas and speak to people around the country that do HMOs. So I'm kind of keen to know what sort of deals you're doing, what sort of numbers, how much properties are worth there.
Yep.
So just over to you, really. Tell us a little bit about the deals that you're doing.
Yeah, so I guess if we rewind it all the way back, it was funny hearing you say that your first introduction to HMOs was, probably second year of uni. It's very similar to Lucy and myself. So we met in uni in Cardiff, and at the time we were paying like a sort of 350 quid a month, which sounds super cheap now, right? And we never spoke to our landlord, but one day he rocked up to do an inspection in an Aston, and we got talking to him and we figured out how many properties he had, and we were quite naive at the time, so we were like, okay, so there's 8 of us living in this house and we each paying 350. We didn't really factor in mortgage costs or maintenance or any of that. We just thought, this guy's probably earning a couple of $100,000 a year from these houses. That's the industry we want to get into. So left uni and we kind of knew we wanted to get into property, but didn't quite know how. So set about kind of going down the corporate ladder, so to speak. And then Lucy and I started flipping houses
on the side.
So living in a house, renovating it, selling it, and then every time we would generate a chunk of capital, we'd reinvest that. Started off doing a few buy-to-lets because that's all we could afford, and then moved very quickly into HMOs because that was always our kind of our goal, is to get into HMOs for the cash flow. So that was probably 2019. We bought our first HMO, which we bought at auction. It was a baptism of fire. Did loads wrong, but it still worked out all right. Fast forward to today, we've got HMOs of all shapes and sizes really. So our smallest would be like a 3-bed maisonette that we actually completed on last week, all the way up to sort of 8 beds. Don't go any higher than 8 beds. There's kind of like a bit of a trade-off. The larger the HMOs are, the harder they are to fill. The management is obviously harder. So we found that's our kind of sweet spot, especially, I guess, in the south with purchase prices the way that they are. Anything over kind of 5 to 6 beds financially makes a lot more sense. The 3-bed is just because it's part of a block, really. But obviously you've got a lot more rental confidence for those smaller deals. So and everything we do is either students or professionals. So we don't do any kind of supported living or anything like that. And obviously being from Bristol, you'll know that there's a great student market there. So you've got two universities. And it's also got quite high retention rates. So a lot of those students, once they finish university, end up staying. So then they're obviously then perfect candidates to go into kind of corporate roles and then become, professional house sharers, if you like. So so that's kind of the HMO side of things.
Is it an Article 4 area?
The majority of Bristol is,
Okay.
Yeah, so probably 2/3 of Bristol is now Article 4. I'd say they brought a new Article 4 direction in last January. which caused a bit of a ripple in the market because so North Bristol, you've got an area that's actually part of the South Gloucestershire Council rather than Bristol. And Bristol had brought their Article 4 right up to the boundary. And then South Gloucestershire started getting sort of inundated with HMOs because it's quite close to the other university, UE. So they put out this consultation and said, right, we want to bring in this Article 4, and that all got approved. And they mismanaged it. So they in essence didn't give the developers enough time. So you're supposed to, I don't know if it's law or just good practice, but you're supposed to give developers 12 months notice if you're going to bring in an Article 4 direction. Otherwise, I guess if there's developers with a pipeline of projects, I guess they could sue them or take them for costs. So they didn't. They gave, I think it was 8 months.
Oh, really? Wow.
Okay. And then what happened, it got right to the end of that 8-month period.
Yeah.
And then they realised what they should have done, and they said, okay,
now we need to give another 12 months.
Now we're going to give another 12 months. So everybody had this like 20-month window where there was like a spotlight shone on North Bristol. So obviously there was like this frenzy, you know, we were doing a few HMOs in the area, and it wasn't our area previously, but we knew it was about to become Article 4. So we thought, right, we'll get in there and you know, smash out a couple before this Article 4 comes in. So, you know, we were there and like you could stand on the top of your scaffolding and every like third house has got a top hat and having the lofts converted and all this sort of stuff. So, you know, there were developers coming in from sort of London and, you know, up north and all over the place, just developing all these HMOs. And they all came online at the same time. And they were all sort of brand new, high-spec HMOs. And they all kind of, like I say, were finished around sort of January time last year. And that really kind of coincided with the change in regulation or change in approach to like international students. So international student numbers dropped. You've also got a lot of like recruitment freezes at the minute. So a lot of the big employers that were local, like Airbus and Rolls-Royce, they all kind of put recruitment freezes on and got the cost of living in there as well. So it became like this little bit of like a perfect storm where you had a massive increase in supply and a reduction in demand at the same time. So it created this like weird little anomaly in Bristol over the last sort of 12 months where rents have kind of really sort of topped out and softened a little bit. And we've been fine. Like everything that we do is kind of we focus on sort of quality over quantity. So you know, large room sizes, loads of amenities, all super high spec, and we're not really pushing the ceiling rents. We'll just match like the next highest person. So ours fills first. So we've been kind of sheltered from it a little bit, so to speak. But there's been a few people that have struggled to let the rooms, and then obviously that then has a downward pressure on rents, and it's been an interesting sort of 12 months really. So
the area around the University of West of England, the north part of Bristol. Is it Filton? Is that that's the Article 4? That's the one, So they issued a non-immediate Article 4 directive where they were supposed to give 12 months notice, but they gave 8. And then because that was not correct, you either do an immediate Article 4 directive, which is instant, and that needs permission from government, I believe. They've then had to get so you essentially had 20 months.
Something like that,
Wow, that's incredible. So what are people doing now that want to do HMOs in Bristol? Is there still an area that you can still do it in, or how does that work?
Absolutely. I think it depends what your model is, right? So there are so many different types of HMOs and different ways that you can finance them and run them, and it all depends on what your goals are, right? So if your goal is to run the HMO model to kind of follow the whole BRR strategy, you know, maybe you've got private finance or maybe you've got a small pot of cash, you're trying to make that go as far as possible. You know, you're typically looking for higher yielding areas, and then you're going to be looking to get commercial valuations on the back end and to really kind of maximize those figures. So typically you're chasing yield into cheaper areas. Okay, so if your kind of goal is to follow that strategy, then ultimately you just keep getting pushed further and further out. As the Article 4s keep encroaching, you just get pushed to the next suburb and the next suburb. Or you're offering sort of subject to planning, potentially inside the Article 4, but then that's quite hard to scale really quickly because not everyone's keen for that. Or you need to sort of pivot and come back sort of central. You're looking for probably existing HMOs inside the Article 4, you know, maybe where you can still add a bit of value. So potentially buying 4s, 5s, taking them up to 6s, because obviously you can do that still under PD without needed planning. or you're just having to settle for lower returns ultimately.
Yeah.
So I guess, the trade-off is typically slightly lower returns, but maybe better rental confidence, maybe they're in a better area, potentially better capital growth, if they're in like a highly desirable sort of owner-occupier postcode. So you still got options. It just depends what your kind of strategy and approach is, and then making it suit.
Amazing. So a few questions for you then, specifically for people that are listening that perhaps are thinking to start in HMOs or if they've got a few and they're looking to grow. Sometimes people will see Article 4 and think, that's definitely not for me. And, lots of hurdles and hoops to jump over if it's an Article 4 area. And like you said, not every seller who you approach to say, look, I want to buy this, but I want to do it subject to planning of me getting this approved is going to be up for that. Some people need certainty of sale and they don't want people to pull out. But what are Bristol and Gloucestershire councils like in terms of their approach to HMOs? So you've obviously had this Article 4 created because there's, I guess, a saturation problem. So are they just refusing all new applications, or is it to do with density, or how are they kind of looking at things?
So obviously you've got your HMO SPD, which should sort of lay out the parameters in which they would approve a HMO inside the Article 4.
Is that like 10%?
So you've got a 10% threshold. You've typically got a sandwiching rule in there. You've also got sort of parking requirements and a few other things, but they tend to be the three main ones that you see across different councils. And to be honest, councils have a very different appetite. So different councils have a very different appetite towards HMOs. Bristol is very anti-HMO, anti-developer, anti-anything, ultimately. They'll refuse everything unless you can prove that you'd win it at appeal, ultimately.
Right.
South Gloucester are a little bit more amenable. I've seen, other councils where we've got kind of mentees that are operating in different cities that are actually quite welcoming to HMOs. And it's quite refreshing. They understand the need for them and they want them to be done well and policed. And, the policy's there to sort of shift the market in a certain direction rather than being like a blanket no. So I think for the listeners, it's really important to understand your local area and the appetite of the local council towards HMOs. So speak to some local developers, maybe a planning consultant that's experienced in the area. Because just because there's an Article 4 direction doesn't mean no HMOs. It can mean they're going to make it very difficult, or actually it can mean as long as you tick all the boxes, you're going to get it approved. So
really
it changes.
And in terms of valuation, so once the Article 4 long-winded mistake that Bristol, South Gloucester or Bristol made to take so long to implement it. But once it was implemented, I appreciate there was a huge flurry of HMOs. But what happened to valuations? Did you see any movement in them now that there was a restriction in that area? Some people say Article 4 has increased the value of their HMOs, and they welcome it in their area if they've already got a number of them. Did you see that, or did you see it just the same valuations, or what happened?
I think over time, yes. I think the way that the Article 4 was introduced in Bristol almost had the inverse effect because it drove prices up before the Article 4 came in because everybody's rushing to get in. So obviously you had people competing for the same houses. And then once the Article 4 came in, all those developers pulled back. So then all of a sudden, then you've got houses on the market. The developers aren't willing to buy them because they can't, obviously they don't have like a fallback position. So actually then prices dipped a little bit. Over the long term, I think it will be good for those of us with the HMOs inside the Article 4. Also, it will help from a valuation from the bank's perspective because you can now get obviously commercial valuations on maybe 5 and 6 beds because they're inside the Article 4. So somebody else needs to get planning to convert it. So
it's interesting,
So there's a couple of different angles to it.
So what would a typical deal look like for you in the Bristol area? Like, talk me through the numbers in terms of maybe a purchase price of something that you bought, how much you spend on it, what do you do to it, and then what do they value at on the back end, really, I suppose? Yeah,
so Bristol, you can kind of still pick up houses in the peripheries, in the outskirts for high twos, 280,000 maybe. You wouldn't be in the most desirable area. Not necessarily where we would want to live ourselves, but you can still do that. And there will be a demand for HMO rooms there, all the way up to if you go into Clifton, you're probably looking at £1 million plus. So, and there are HMOs in all of those areas. if we talk about an example that we included in our application to the awards, so that was a property that was originally on the market for it was 375, okay, and again this was before the Article 4 came in, so there was loads of interest. It sold for about 400k, okay, so 25k over asking, and this was just before the Liz Truss mini budget, so it's probably the height of the market, I would say. And before interest rates obviously went skyward. So somebody else paid or was going to pay 400 for it. The mini budget happened. They got spooked. They pulled out. Nobody was buying. So then it sat on the market, got dropped to 350 and we picked up for 335. So we picked up 65 grand less than somebody else was willing to pay for it sort of 4 or 5 months previously. The reason why we liked that particular property was because it had a big a big plot, so it had already been extended to the rear, and then it also had a big side plot, so we knew, right, we can do a side extension under PD. It's already got the rear extension. We can then also convert the loft under PD. So in terms of the building work aspect, we can do all of this under PD, and then it's just a matter of, is it going to be 6, 7, 8 bedrooms internally? So we actually got planning for the 8-bedroom HMO on that one.
Right.
So purchase price 335. Off the top of my head, I can't remember exactly what the purchase costs were, but the refurb was about 230 all in, and that one got valued up at 840. So it was there or thereabouts, sort of all money out deal. So
105 grand a room.
Yeah, exactly that.
So it's interesting, isn't it? Because there's certain parts of Kent which the rooms are valuing at about 100k a room.
Yeah.
So So on that particular property, did you do multiple planning applications? So did you go C3 to C4, got your fallback position as a 6-bed, and then go from there to sui generis?
Yeah. So with that one, we ran them kind of back to back.
Cool.
So we put in the PD application a day later, submit the full application, knowing that the council are probably going to take 10 weeks to maybe 3 months to assess the full application. But obviously they'll make a decision on the PD application within 8 weeks. So the PD gets approved a couple of weeks later. They're reviewing the full application, having already seen that the PD's been approved. So then it's not a matter of, discussing whether it's going to go from a 3-bed to an 8-bed. It's saying, well, actually, it's going to be a 6-bed. The building work was approved anyway, so there's no external changes. It's just a matter of, is this going to be a 6, a 7, or an 8? Yeah,
amazing. Sounds really interesting that the way you're doing things, and it's quite similar to some of the things that I'm doing as well. Are you fully invested in Bristol, or do you have properties in other locations as well?
We have a few dotted around. So when we started out, I guess we were following the deals, and we were kind of having to buy in cheaper areas where our funds would allow us to. But we've really kind of niched down on Bristol. So that's where the build team are. We're on hand. If agents come to us with off-market deals, or we've got certain vendors that we kind of buy from. So if they ever said, right, we've got this coming on the market, we can be there at a drop of a hat and view it. So we've got a few things in Wales, and we've got a chapel down in Cornwall, which is the bane of our lives. But so apart from those sort of 5 properties, they're all in Bristol.
Yeah, no worries. So for anyone listening to this who's thinking, right, let's dive deep into Bristol and start doing some HMOs. You've now put them off completely because they thought Article 4 and there's going to be an absolute pain. But as you said, the peripheries, there's still some potential around those areas. It's just whether that will work from a saturation point of view and whether the numbers are going to work from a rental perspective. And something interesting that you said around when you market your rooms in terms of the rents. I was talking to a friend who's got a large volume of HMOs in the Medway area in Kent. And he was saying to me, in hindsight, what he was doing was creating these really high-end luxury HMOs that were far exceeding all competition in the area. And he was putting them up and renting them at like record levels of rent. But what he found was that after a year or two, some of the people, or certainly after a year, the tenants would leave and they would move on. And then in the second year, it was slightly not as attractive as the previous year because some more stocks come to the market that's similar to his. And also, it's when something's brand new and fresh, it's easier to get that sort of rent. So what he found was in the second year, he wasn't achieving the same rents as he achieved in the first year. And his comments to me were around, I should have just kept them a little bit cheaper to start with, and let the tenant stay for 2-3 years and not had to change the tenants all after 1 year. And I thought it was quite interesting because when a lot of people bring a HMO to the market, it's not something you would ever really consider at the beginning. Like, oh, let me just find my competitor and just match their rents so that I can fill my rooms quicker than theirs. Some people, certainly if they're new or haven't had that experience happen to them, they would just go, oh, mine's 10 times better than theirs, so I'm going to stick it up for 100 quid more on spare room and do a featured ad and give it a go and see what happens. So sometimes actually just taking a step back and thinking, what are you doing? You know, like what are you actually building here, and what headaches do you want to create for yourself? Because let's face it, we don't want to keep changing the tenants every 6 months.
Absolutely not.
It's a pain, isn't it? So that was just quite interesting what you said about just matching yours and filling. And the key thing for you is to fill the rooms, isn't it?
100%. You know, what is the worst thing that could happen as a HMO developer? You know, you can't fill your HMO. You know, you spend all this time and money developing something. You know, if you can't fill it, I think that's probably, you know, ultimately the worst case scenario, right?
Yeah. So from a building regs perspective, because there seems to be a lot of discrepancies between areas and building control inspectors and local authority versus private and which location you're in. But so on some of the sui generis HMOs that you're doing, how intensive is the building regs compliance? So are you doing impact and airborne sound testing on completion? Are you having to do AOVs, any fire lobbies? What sort of headaches do you have to go through?
So not too bad actually. So although it's interesting because there seems to be quite a lot of variation between different building inspectors. Even different building inspectors within the same company will give you different advice. You know, so we've kind of got our spec, and you know, there's no AOVs, no fire lobbies. They want you to, one inspector will want you to upgrade the soundproofing. One inspector will want you to do the whole kind of,
resilient bars.
Resilient bars and all that sort of stuff. And yeah, even if we use a private building control company and get different inspectors, they want different things. But no, I think from our experience so far, we've got away quite lightly compared to what I've heard other people have had to do in other areas and with different inspectors, and particularly when they've gone to the local authority because they obviously just go by, you know, there's no kind of, allowances or tolerances at all are there. So so none of that, thankfully. I think also there are some slight differences if your target market is students and you're renting to one group on an AST. Sometimes the building inspector will look at that slightly differently, because I guess the theory is they're all a group of friends. They're on one joint and several AST. They all know each other. So if there's a fire, they'll all kind of get each other out. Whereas if it's professionals and they're kind of in their individual rooms, they don't know each other, then I guess it's looked at more along the lines of potentially like a block of flats.
And there's a big difference in those compliance requirements, isn't there?
Huge.
So sounds like to me, and from talking with you prior, HMOs were the go-to thing, but it sounds like you've maybe eased off a little bit on going crazy in HMO investing at the moment, and perhaps you're looking at some other alternative options for investing, but still in property, right?
Still in property. So we're all in on property. You know, we don't really do or invest in anything else.
Can I ask why?
We love property. Genuinely, we love it. So I had a background on the tools before I went to uni. I love the process. Lucy loves the interior design. You know,
when you say on the tools, what were you doing?
I started off as a labourer.
Oh, right,
my dad ran a kitchen business, so I sort of went into fitting kitchens. Before uni, went and did a bit of management, degree, and went into middle management, and that was just stressful. So I came back to property. Yeah.
The only reason I asked that, it's a bit of a weird question. If you're listening, you won't know this, but if you're watching this, we had a conversation prior, but you're 6'6", and I thought maybe a bit of plastering would be ideal. No stilts needed. Just literally skim the walls whilst you're...
I can do pretty much everything but plastering.
Carry on.
So we love it. So when we worked in the corporate jobs, we would, you'd rush around, you'd be busy, you'd be working 60-hour weeks. And yes, obviously you get a decent salary, but you step back at the end of the week and you've got nothing to show for your hard work. We love the process of taking, rundown properties or a commercial unit or maybe like a 3-bed semi-detached house and then transforming it into this, high spec, all singing, all dancing property. And, the fact that property is extremely difficult almost makes it more rewarding when you actually stand back and look at that sort of end result.
Yeah.
So we actually love what we do. So that's why we're just kind of all in. Obviously, it helps that you can make some decent money from it.
Yeah. And so if you compare it to other investments, because this podcast is all about property, I'm pro property. Most people that come on here are property investing of some sort, or they're a professional in the property space. But if you compare it to other investments, so investing in the stock market, index funds, filling up your pension, a business of some sort, are you like in any of that, crypto, or do you think property is just the thing to stick to and you want to focus on?
Property is the thing. Obviously, we're going through the motions with setting up our SAS pension. So again, we can use that to buy commercial property. But no, we're all in with property. We see it as sort of a steady and fairly safe sort of asset class. You can't have a knee-jerk reaction and sell a property because it takes 6 months probably. So you just have to ride out any bumps in the road. And ultimately, our model is we are forcing value and we're forcing that appreciation. So whether it's taking a family home, converting it into HMO, whether it's taking a freehold block of flats and splitting it up and selling them off individually, whether it's converting something from commercial to resi, everything that we're doing is adding value.
Yeah.
And then you add leverage into the mix, and we think we can get higher returns and it'd be safer than the likes of crypto and things like that.
Yeah, absolutely. I mean, a lot of people would say crypto's gambling because the fluctuations in it is just crazy, isn't it? But some people have made an absolute fortune, and you sort of wish you had a bit of the pie, don't you? But right, so Lucy's not here today.
Nope.
Okay, but I understand that you invest together.
Yes.
How does that work? Because I'm trying to think now, if I brought my wife into the business, how the dynamics would work of, maintaining a marriage, and you've got children, I believe, as well.
Got a kid,
and then also both working together and both trying to build, run the engine and build the business. How does that work for you? Yeah,
it's an interesting dynamic because there's no filter when it's your life partner.
Yeah.
If it was a business partner, you'd probably speak in a bit more of a professional manner. So we also have quite different views. Okay. So quite often we'll be assessing an opportunity or discussing, which route we want to go down, and Lucy will be one end of the spectrum, I'll be the other. And actually, sometimes there'll be some heated arguments about what's right, and we'll be sort of thrashing out some ideas, but we naturally tend to settle somewhere in the middle. And then in hindsight, when we look back, we're like, actually, that was the best. That was the best outcome, really. So I think we've both got different skill sets, different views, and it can cause some confrontation, let's say, but ultimately it all ends well.
Do you have any rules, let's not talk about property at dinner, or because the only thing I was just sort of thinking is your life, because property people we just talk about property all the time.
Absolutely.
Don't we? I go to some networking events and all we talk about is property the whole time. Yeah. And if I got home and then started talking to my wife about property, I think she would just shut off straight away and be just stop talking to me about that, because I'm not interested. Much more interested in talking about the latest gossip or something. But do you guys have boundaries, or is it just work and personal life just mixed together and you just love it so much that you're both...
It's kind of just blended into one, really. We probably should have some boundaries, but we haven't quite figured that out yet.
Yeah, amazing. So you're talking a little bit about blocks of flats.
Yes.
Is that the focus now? What's the focus going forward? You've mentioned the SAS, so you're keen to looking at getting some funds into the SAS and potentially buying some commercial property. Yep. What are your focuses for, say, the next 5 years?
So for us, we've got two strands to our business. We've got the investment business that buys stuff to hold, and typically we're focusing on high yield and cash flow. That ultimately pays the bills. Then we've got another development trading business that focuses on generating chunks of capital. Mm-hmm. And the way that we've grown our business to this point is we've always kind of run the two, you balance the two, so to speak. So you do a flip, you generate some cash, and then you reinvest that into the investment portfolio to hold for the long term. So what we found is HMOs are great for cash flow. That got us out of our day jobs. It's allowed us to do some more creative deals and maybe some longer term deals where, you might be in a deal for 18 months, 2 years, potentially longer in some cases. Without the cash flow, you wouldn't be able to do those projects in the first place. But our focus at the minute is a lot more on the capital generating side of things. So we've bought and sold quite a few blocks of flats in the last sort of 18 months. So the way that those have worked is we've bought them on a yield. So typically with blocks of flats, they work the opposite way to commercial valuations on a HMO. So on a HMO, your commercial valuation's quite often higher than your bricks and mortar. Not always, but quite often. With blocks of flats, it's the other way. So the commercial valuation will be lower than the bricks and mortar valuation or aggregate bricks and mortar valuations of all the individual units. So we've been buying a few of those blocks and then title splitting them, creating the leases, and then renovating and selling them off individually and just generating chunks of capital that way. And then
Is that working well?
Yeah, really well.
So I don't know the market.
Yep.
Certain areas where I operate, there's a saturation of flats, and actually people are trying to avoid renovating and selling flats. Some areas work really well, others don't. But so if you're buying a block of flats in Bristol or around those areas, and then you're breaking them up, like you said, creating new leases, title splitting everything and selling them off, doing them up, are you managing to sell them easily? If you're like, how many are you bringing to the market? And just talk me through, give me an example of a deal if you can, so we can kind of analyze it a little bit.
So a deal that so all these flats are sold subject to contract. 2 of them are complete, 3 of them not. But bought a block of flats about 12 months ago. Purchase price was 757. Spent circa 200k just below on the refurb, and split the titles, generated all the leases, sold them off individually, and the GDV of that is 1.42, I believe, so just over 1.4. So it's about, once you've factored in purchase costs, finance costs, all that sort of stuff, sort of just over 200k profit in that deal.
And is your stamp duty, so I'm asking some technical stuff now, but because you used to have multiple dwellings relief, I believe that's gone now.
MDR's gone,
but over a certain level, you can still, from my understanding, get commercial stamp duty payable rather than resi. So what's the number, and did you manage to get that on this particular deal?
So that particular deal, we completed just before the MDR was taken away.
Oh, amazing.
So that was 5.
Yeah.
But we were able to use MDR. You've now got the rule of 6. So basically, it's over 6. So 7 and more, you get commercial rates of stamp duty. So we bought a block last Thursday.
Oh, wow. Congratulations.
And that was 8. Thank you. That was 8 properties, 2 of them HMOs. So there's a 4-bed Muse house at the back and then a 3-bed maisonette that I mentioned earlier. And because it's 8 properties in one transaction, it's commercial rates of stamp duty. So
which makes a huge difference.
Huge difference, yeah.
And then you'll split it all up and start selling them off and keeping which bits you want to keep.
Yeah, for that one, I think the strategy is a bit different. We'll look to maintain it and hold them for the long term because there's some HMO elements in there. So it works from a cash flow perspective. Whereas in Bristol, if you've got flats valued at, £350,000 for a 1 or a 2 bed flat, and the rent's only between 12 and 1,500. They don't make much money.
No.
By the time you're factoring in today's interest rates and a bit of maintenance, they're good. They're a good equity play if you want to hold them for the sort of the capital growth and just a bit of diversification within your portfolio. But they're not anywhere near as exciting as HMOs in terms of a monthly profit.
Yeah. So the strategies going forward for you are keep flipping and generating cash, keep holding the high yielding stuff.
Yeah.
You like the title splitting of flats, and you keep looking. Where are you sourcing those sort of opportunities? Are you doing auctions, or are you sourcing on the market?
Most on the market,
really?
Most off market.
Off market.
Yeah. So up to this point, a good proportion of what we've bought has been on the market. But the more you do, the more you get to know the agents, the more you get to know the other landlords in the area and who's selling what. There's a lot that actually does trade hands off market. So of those, let me think, we've bought 5 blocks of flats in the last 18 months.
Cool, you're not hanging around.
All of them have been off market.
Yeah.
One of them did go on the market, sold to somebody else. They pulled out, and then the vendor came to us because we had a relationship with the vendor. We'd bought stuff from them before, and they said, look, I'm trying to sell this. They were sick of it. So they'd gone to webuyanyhouse.com.
Oh, I see, yeah.
And they said, right, well, they've offered me this. Can you match it? And we were like, no, I'm really sorry, but it just doesn't work for us at that value. So we said, look, if we were to twist our arm, this is what we could pay for it. And it was again like a 25k, discount from the We Buy Any House price.
Wow.
But because we had a relationship with the vendor, she was like, yeah, fine. You have it. Yeah, you have it for that.
Amazing. Well done. That sounds incredible. Yeah. Most people would be paying more, wouldn't they, to secure it? So getting it under what sort of trade buyer would be buying it.
We actually didn't want the deal.
Oh, really?
Genuinely didn't want it. So we thought by offering that low, we would have put her off.
Yeah.
But I think her husband was a developer. She sees what we're trying to do, and I think she said, "Well, I'd rather sell it to you than one of these big corporations." So that's how we got it.
Question for you:
Yeah,
if you could go back, so let's rewind now. You've met your landlord. You've seen the Aston Martin.
Yeah.
The light bulb's gone, and you thought, right, I need to do some property. What would you do differently now, knowing everything that you know? What would you change anything?
So if I could go back, but I had the knowledge that I have now, I think we'd be going into much more creative deals early on. We've done loads of just bread and butter deals, just fairly average deals, loads of HMOs that we're leaving, 70 to 100, 150k sometimes in deals. We're putting in the sweat equity and flipping houses. And it took us a long time to build up the equity and build up that track record. If I could go back, but had the knowledge, I think I could leapfrog quite a few years and just do more creative deals where potentially you need less cash up front and the returns are higher. I think you would fast forward a few years, wouldn't you?
Absolutely. Really interesting. And then for people that are listening now who are perhaps at that earlier stage of perhaps they're in a corporate job and they're thinking, look, life sucks. I get the train every day up to London. I work all hours God gives. And my salary's great, but I don't want to do this forever. Yeah. Property seems to be something for a lot of people that they can venture into and can create wealth, but it's not an instant overnight
Absolutely
thing.
not.
So what advice would we give to those individuals who are much earlier on? What would be your tips that you would say, go and do this first before you do anything else?
I think, like a lot of things in life, it's about relationships. So it's about who you know, not necessarily what you know. So I would put myself in the right circles where you're networking with the right people, whether that's networking events, whether it's online through social media. There's so many different avenues that you can get to know people.
Do you go to any networking events?
Yeah, quite regularly actually.
In Bristol?
In Bristol, yeah.
Partners in Property?
Yep.
So them lot down there. They're good.
On Friday actually. This
week.
Right,
yeah, amazing. Yeah. So you meet with Adam Lawrence if he turns up down there.
All those guys. Yeah.
Yeah, amazing. Seems to be one of the better ones, doesn't it? The Partners.
Pip's good. Yeah, there's loads. Even the ones that I don't necessarily go to. You can still bump into the right people there.
Yeah.
So I'd do that. I would get amongst the right people, and there's a lot to be said for just connecting with the right people who have done what you want to do. There's only so much you can gauge from reading books and podcasts and stuff. Sometimes you need to, ask people about your specific situation or your local area or their experience.
So what do you then? So leading on from that, network, meet with other property investors, pick people's brains, learn, go for coffee, buy someone a meal just to get an hour's time with them, all that sort of stuff. But what do you then think about property education? So people that are buying courses from various companies, what do you think about that? You can be general or you can be more specific.
Yeah, I think it works for some people. We've never done any formal training. So it's kind of hard to slate it when I've never actually sat in the room and listened to them talk. I think it has a bit of a bad rep in this industry. But I think it comes down to the individuals, right? So you can do all the training in the world, but if you're not taking the action and if you don't have the right mindset and you're not coming away and putting those things into practice, you're never going to make it work. So I think they probably a lot of those the bigger training courses don't. There's no like pre-qualification. They don't differentiate between whether you actually got the funds or not. They're just it's a bit of a funnel, isn't it, really? So got a bit of a bad reputation, but there are some very, very good, incredible trainers out there. You mentioned Adam Lawrence. I've been to one of him, and he does this does this day once a quarter with Rod. Fantastic value. It's like being back in my business management degree doing economics.
Yeah, Adam, if you're listening to this, you are the absolute rocket scientist of property. Adam does something called Proponomics. I don't know if you, and he's just, it's well worth subscribing just to the supplement 100%. That they send out because it's so informative, and I pick things up from there all the time. Also, I'll plug Adam's property networking event. So Partners in Property is amazing. I think they might have 4 or 5 meets across the country: Bristol,
Birmingham.
Central London, Birmingham, and Manchester, I think. And they're not expensive. These things are, I'm going to get this completely wrong.
70 quid a month.
Yeah, the London one's probably more. You get lunch, you meet with all these people, you hear talks. They're a daytime thing, so they're not like a nighttime property networking event. But just really good people. So get yourself down to your local partners in property if that is of interest to you, and sort of see it as like a really great way to just mingle with other people as well that are like-minded. There seems to be some good high quality. It's not this is going to sound terrible for anyone who wants to do rent to rent, but it's not your rent to rent crowd typically at these places. No. There are some other networking events where you go to where everybody in the room is sort of very early on in their career, and a lot of people perhaps don't actually have any money to start investing, and that's not necessarily a bad thing. But Partners in Property, I would say, is a bit more sophisticated, and there's more people there that are a bit more established. So sometimes you're in the room and you're sat next to someone who's, already got 40 odd properties, and they're doing a ground up development scheme, and you're mingling with people that are you can learn from, if that makes sense. So
because it's our whole day, it's people that are in property full time ultimately.
Yeah. So we'll put a link to Partners in Property. I'll also put a link to you guys Instagram and stuff like that as well, if you're happy for us to share all of that. People want to go and follow you. So for yourself then, you mentioned you do a bit of mentoring, coaching. Could you talk a little bit about that and how that works?
Yeah, so we do a bit of mentoring in collaboration with Andy at the HMO Roadmap.
Okay, yeah.
So it's mainly around HMOs for people that want to sort of replicate a similar sort of model across the country. We actually don't mentor people in Bristol because we think it's a bit of a conflict of interest. That's where we kind of operate and grow our business. But yeah, for us, it's a rewarding thing that we do. So we limit the amount of people that we mentor. We would never mentor more than sort of 10 people at one time. Ultimately we make a lot more money, doing our main thing, which is buying and developing property. But it's nice to work with a small handful of mentees to help them, buy and develop and build their portfolio across the country. So yeah, it's rewarding, and actually when I look at the mentees that we work with, when I go back, when your question, if we were to start again, what would we do? A lot of their deals are probably comparable to maybe our 4th and our 5th and our 6th HMO. So what we've done is we've been able to kind of point them in the right direction, hopefully stop them making a few of the mistakes that we made to start with, and really just kind of leapfrog those first couple of years worth of mistakes and experience that we had to go through. Yeah,
I think that's amazing. I try to think back to some of the first deals that I did, and I just think, God, why did you do that? You don't know what you don't know, and that's the thing. And
that's it.
Sometimes I wish, going back, that I'd had someone who perhaps was 5 years further ahead than me, that I could just pick their brains a little bit. And I naturally found people over time, but the first couple of years, property can be a very lonely, if you're on your own and you're just looking for things, you need a sounding board, you need to run things past other people and sense check it and say, just learn from other people's mistakes. Just constantly making mistakes on your own, you do get better, but it just takes time, doesn't it? And
Absolutely.
So sometimes just saying, well, look, this is why I wouldn't do that. This is what you should do instead. It's just, it'd be great to have that knowledge from other people. So it's great that you're able to give back to some people that do want to do that. And I'm not sure if you could share those details. If you want to, we can put that in the show notes as well.
Yeah, just follow us on sort of socials and reach out to us through that.
Yeah, amazing. Yeah. Okay, well, look, we'll leave it there if it's okay with you. And I just wanted I normally round up each episode with a recommendation from the guest. So this can be you recommending a book, another podcast, or a tip, or a website, or something that you think could be useful to the people listening and watching this video. Is there anything you could recommend?
Yeah, so book-wise, we've read a lot of the property-related books, and quite often a lot of it is, it doesn't always sink in, but there's a few that I'd probably spring to mind. So one we've kind of already touched on, which is a book called Who Not How. To be honest, I don't actually think I finished the whole book. Once you've read the first, quarter of it, you probably get the concept. Yeah. But that's about, figuring out who you need to speak to solve a problem, not figuring out how to do it yourself. Because property is an industry of multiple disciplines, right? So, you've got the finance element, you've got the build element, you've got the lettings element, you've got all that sort of stuff going on. you cannot be expected to be the expert in every single field. So network and, reach out to the people who are the experts and pick up on their sort of, pick their brains for their year's worth of advice.
Yeah, amazing.
And the only other one was a book called Oversubscribed by Daniel Priestley.
All right, yeah.
I don't know if you've read that. So the content of the book isn't directly relatable to property, but the theory behind being oversubscribed for everything that you do, I think is something that is a great idea, and something, whether we're selling a flat, whether we're renting a room in HMO, we're always trying to drive demand. So whether you're trying to drive best and finals, or whether you've got a waiting list of people for HMO, you then get to pick the best. So I think oversubscribed, or being oversubscribed, is something that you can apply to any business, and it works well for us.
That sounds really interesting. I'll put a link to both of those books at the end for anyone who wants to check those out. They sound super informative. So, and again, thank you so much for coming down and making a journey from Bristol, and hope you all enjoyed, and we'll see you at the next episode.